After understanding EBIT, we come to the understanding of EBT. Now, if you again see the difference between EBIT and EBT, I has gone out of EBIT. So as I told you earlier, when we removed depreciation and amortization out of EBITDA, we arrived at EBIT. And when you remove interest out of EBIT, you arrive at something called as EBT, which is earnings before tax. Now all these figures or all these terminologies are used by business at various levels of their operations. They customize the use of this information depending upon their requirement. So again, I have again included that same pyramid here where EBITDA minus DA gives EBIT minus interest gives EBT, earnings before taxes, which means the final earnings of a company before they are ready to pay out taxes. Now, when you deduct taxes out of EBT is when the company arrives at net income. In the income statement, which I had shown in the previous slide as well, now you can very easily make out where EBT should feature. It's after the operating profit or the EBIT, and out of that, when you deduct interest. Now, what should this interest be? This interest is primarily, since we have deducted interest out of EBIT, it is very obvious that this interest is something that the company pays and not the interest that the company receives. This payment of interest is primarily the interest which the company pays on its debt instruments. All the debt investments which the company has done, the interest payment on that debt instrument, when deducted out of EBIT, gives you the EBT. Thanks. We will discuss EPS in the next pack of slides.